Is the money you saved really still yours? That question sounds absurd, but the answer may make you uncomfortable. There are three things you probably take for granted. First, interest rates are determined by the market. Supply and demand naturally find equilibrium. Second, your money is yours. You can buy whatever assets you want, and no one can interfere. Third, governments will never directly touch your bank deposits because they are private property. For roughly the past 40 years, those assumptions have mostly been true. The money you deposited in a bank was yours. You could buy U.S. stocks whenever you wanted. Interest rates were largely shaped by market forces. It all sounds perfectly natural, doesn't it? But what if I told you that, in the broader sweep of human history, these three assumptions were never truly stable norms? What if I told you that the past 40 years were actually the exception, not the rule, and that we may now be leaving that exception behind and returning to a much older and far more common system? How would that make you feel? There is an investment historian named Russell Napier who has spent decades studying nearly 200 years of financial market history. He dug through financial data from the 18th century all the way to the modern era and eventually came to one conclusion. We may be leaving behind that extraordinary 40-year period and entering a new era in which governments deeply influence where capital flows. He calls this era financial repression, and he believes this transition could last 10 to 15 years. During this period, the rules of investing may become completely different from what people have grown used to. Long-term bonds could become one of the most vulnerable asset classes. U.S. equities may no longer deliver the kind of returns investors enjoyed over the past decade. And the bank deposits you think are safest may quietly lose purchasing power year after year if they fail to keep up with inflation. Today, I want to fully break down this framework for you. Not so that you blindly accept it, but so that you become aware of a possibility most people have never seriously considered. And simply placing this possibility into your mental framework may be enough to change every asset allocation decision you make over the next 5 or 10 years. Let's begin with a set of numbers to understand how large the issue really is. Using broad measures, foreign holdings of U.S. assets are now approaching $70 trillion. Foreign ownership of U.S. securities alone exceeds $35 trillion, already far larger than America's annual GDP. Whose money is this? It is the retirement savings of European pension funds, the insurance premiums managed by Japanese life insurers, the capital of British investment trusts, the sovereign wealth funds of the Middle East. For the past 40 years, these institutions have continuously funneled the retirement savings and insurance contributions of ordinary citizens into American markets. Why? Because U.S. equities performed extraordinarily well. Because the U.S. dollar remained structurally strong. Because U.S. Treasury bonds were considered the world's ultimate safe asset. The retirement savings of the world flowed across the Pacific and Atlantic Oceans into the United States. And this capital flow continued for 40 years. 40 years is a very long time. Long enough for everyone to believe this was simply how the world naturally worked. But Napier argues this is not an eternal law. It was merely the product of a particular historical period. And that period may now be ending. Why? Because government debt levels have become so large that they are extremely difficult to repay through conventional means. Using standard international measures of general government debt, U.S. government debt exceeds 120% of GDP. France is near 120%. The United Kingdom is above 100%. Japan is even more extreme, still among the heaviest debt burdens in the developed world, with debt exceeding 200% of GDP. Nearly every major economy is carrying an enormous mountain of debt. How did this happen? For decades, whenever economies weakened, governments cut interest rates, printed money, and expanded fiscal spending. Every cycle worked in the short term. But debt kept piling on layer after layer. And now it has reached levels that are very difficult to solve through traditional methods. In theory, there are 5 ways to resolve excessive debt. The first is rapid economic growth. If GDP grows fast enough, the debt burden naturally shrinks relative to the economy. The problem is that most mature economies today no longer have strong long-term growth momentum. The second is drastic cuts in government spending. But programs like welfare, healthcare, and defense are politically difficult to cut. Slash them too aggressively, and elections may be lost. The third is major tax increases. Politically, this is just as difficult. The fourth is outright default. But sovereign default destroys national credibility and creates catastrophic consequences. The fifth is financial repression. Napier believes the first four options are extremely difficult in practice, which is why governments may ultimately choose the fifth path. So what exactly is financial repression? In plain language, it means governments use policy tools and financial regulations to keep interest rates below the inflation rate, forcing real interest rates into negative territory. Here's a simple example. Suppose inflation is 5%, but your bank deposit only pays 2%. On paper, your savings still grow by 2% each year, but prices rise 5%. Your account balance increases, yet your purchasing power quietly shrinks by 3% annually. You don't feel it directly, but your wealth is being transferred away from you. Transferred where? To borrowers. Because inflation also erodes debt. If a government owes $1 million, inflation gradually reduces the real value of that debt. The government's debt burden becomes lighter. At the same time, savers lose purchasing power. Wealth quietly moves from savers to borrowers. And the largest borrower is often the government itself. This is not just theory. It already happened in history. From 1945 through roughly 1980, countries like the United States and the United Kingdom use negative real interest rates, capital controls, and financial regulation to reduce the enormous debts accumulated after World War II. During that period, bondholders and savers systematically and quietly lost wealth. Most people never fully realized what was happening. Napier believes similar mechanisms may now be returning in a modern form. But for financial repression to work, one critical condition must exist. Governments must be able to influence where money flows within the financial system. Specifically, through regulatory rules, capital requirements, investment guidelines, or policy incentives, governments encourage domestic pension funds, insurance companies, and banks to hold larger amounts of their own country's government debt. Why? Because government bond yields can only stay suppressed if there is consistent demand for those bonds. If nobody buys them, market forces will drive yields higher, and financial repression collapses. So governments do not necessarily need to openly command institutions to buy bonds. Instead, pension funds and insurers gradually understand that allocating more money into domestic assets better aligns with policy objectives and regulatory expectations. This creates a chain reaction. Napier calls it capital nationalism. If European pension funds are encouraged to buy more European sovereign bonds, their capital is no longer unlimited. To increase domestic bond holdings, they must reduce exposure elsewhere. What do they sell? Most likely the same assets they accumulated most aggressively over the last 40 years, highly liquid American assets. Japanese life insurers face the same dynamic. If Japanese regulators encourage them to buy more Japanese government bonds, they may reduce overseas allocations, especially U.S. equities and U.S. treasuries. The same logic applies to Britain and France. If multiple countries simultaneously push capital back toward domestic assets, the result is that money no longer flows frictionlessly into the United States. Instead, governments begin guiding capital back home. So Napier's warning is not just about internal domestic policy. Financial repression in Britain could become selling pressure for American assets. Financial repression in Japan could also become selling pressure for American assets. Countries trying to solve their own debt problems may begin pulling capital home, and a large portion of that capital has spent the past 40 years parked inside U.S. markets. Out of nearly $70 trillion in broad foreign claims on U.S. assets, even partial reallocation or simply slower future inflows could create major pressure on American markets. At the same time, political and policy uncertainty in the United States has also been increasing. Tariff policies have become more unpredictable. Geopolitical tensions continue to rise. Some foreign investors have already started reassessing the risks of holding U.S. assets. The tariff shock of April 2025 was one example. Foreign investors began asking themselves, why should we continue placing so much money into a country where policies can suddenly reverse? Napier's conclusion is that returns on U.S. assets over the next decade may be significantly lower than they were during the previous one. At the very least, real returns may face much greater pressure. That does not necessarily mean the U.S. stock market will collapse. But it does mean the era of blindly buying the S&P 500 and effortlessly compounding at double-digit annual returns may not repeat so easily. Interestingly, Larry Fink, the CEO of the world's largest asset manager, has been discussing remarkably similar themes, though using completely different language. In his 2025 shareholder letter, Fink argued that the world will need roughly $68 trillion of infrastructure investment by 2040. Data centers, electric grids, energy transition projects, massive infrastructure spending. But governments are already running huge deficits, while banks face increasing regulatory restrictions on lending. His conclusion? Capital markets and private savings must play a much larger role. Governments no longer have enough fiscal capacity to fund everything themselves. More household savings and private capital must be directed into long-term investment projects. Napier calls this financial repression. Fink calls it the democratization of investing. One sounds frightening. The other sounds optimistic. But at their core, both point toward the same reality. Governments and corporations no longer have enough capital on their own. They increasingly need the public savings to help finance the system. Fink even proposed a concrete mechanism, tokenization, using blockchain-style technology to divide stocks, bonds, and investment funds into smaller, more easily tradable units so ordinary investors can participate more easily. He argues tokenized funds could eventually become as common as ETFs. It sounds attractive, but from Napier's perspective, this may also represent a mechanism for transferring long-duration investment risk from governments and corporations onto ordinary savers. And of course, Fink is not speaking without commercial incentives. BlackRock has aggressively expanded into infrastructure investing, private market data, and private credit in recent years through acquisitions like GIP, Prechin, and HPS. They are positioning themselves for this future. Tokenization, private markets, infrastructure investing. Every layer potentially generates management fees. BlackRock is not a charity. It is building for a new financial order. Regardless of motives, however, the direction is becoming clear. Long-term investments, governments, and corporations cannot fully finance themselves are increasingly being shifted toward private savings. What does this framework mean for investors in Taiwan? In many ways, Taiwan is already experiencing trends that overlap with Napier's thesis. For years, large amounts of Taiwanese capital flowed into real estate. In response, the government introduced a series of housing controls and credit restrictions, including selective credit controls, real estate taxes, and tighter mortgage rules attempting to cool speculative leverage and overheated property markets. At the same time, Taiwan has been promoting capital market reforms and asset management initiatives designed to redirect more money into capital markets and industrial investment. Using Napier's terminology, this is Taiwan's version of capital reallocation. The government is consciously influencing where capital flows. The mechanisms differ somewhat from the banking system focus Napier emphasizes, but the underlying principle is similar. Governments are increasingly shaping capital allocation, and Taiwan possesses one major structural advantage in this environment. Napier argues that in an era of state-guided capitalism, governments tend to concentrate resources into sectors like industrial production, defense, energy, infrastructure, manufacturing, and raw materials, the so-called old economy. Taiwan happens to hold globally competitive positions in several of these areas. Semiconductors, of course, need little explanation. TSMC is one of the most strategically important companies in the world. In an era of geopolitical tension, advanced semiconductors are strategic assets. Governments are willing to spend enormous amounts to secure supply chains. Taiwan's position in this sector will be extremely difficult to fully replace in the short term. Defense is another example. Taiwan's push toward domestic defense production is accelerating. Submarine programs, missile manufacturing, drone development. These are all areas where governments are likely to continue investing heavily. Shipbuilding may also regain strategic importance as supply chains restructure and energy transportation and defense needs evolve. So if Napier's framework is correct, if an era of government-directed capital allocation is returning, then Taiwan may actually be holding relatively favorable cards. Napier also made a fascinating observation. He said that if you want someone to manage your portfolio, you might prefer hiring a South African or Brazilian investor. Why? Because investors in those countries have spent decades operating in environments where governments heavily influence capital flows. The skills they developed may become increasingly relevant for developed market investors in the future. For the past 40 years, investors in advanced economies grew accustomed to the logic of free markets and efficient markets. Analyze financial statements, build DCF models, estimate valuations. But the next era may be one where governments steer capital through regulation, subsidies, industrial policy, and national security priorities. Those who understand government intentions may gain a major advantage. Ironically, Taiwanese investors may already be familiar with this style of investing. Government industrial policy, the attitudes of development agencies, the actions of the central bank, all have long exerted powerful influence over Taiwanese markets. This could become a unique advantage in the next investing era. Of course, Napier's framework is not without weaknesses. Every framework has blind spots. Here are 4 major counter-arguments. First, what if central banks remain independent? Financial repression requires interest rates to stay below inflation for long periods. But if central banks remain independent and committed to inflation control, they can raise rates high enough to suppress inflation. That would directly undermine financial repression. In fact, from 2022 to 2023, the Federal Reserve did exactly that. It launched the fastest rate hiking cycle in decades, bringing inflation down from above 9% toward roughly 3%. If central banks can truly maintain independence over the long run, Napier's scenario becomes much harder to sustain. Napier's response references a historical figure, Arthur Burns. After stepping down in 1979, Burns delivered a speech titled "The Anguish of Central Banking." In that speech, he admitted central banks do possess the tools to fight inflation. But under political and social pressure, maintaining extremely tight monetary policy becomes extraordinarily difficult because it creates unemployment, recessions, and political backlash. The core message was simple. Central bank independence becomes extremely fragile during periods of national stress, especially during geopolitical competition. In the 1960s and 1970s, America's national priority was winning the Cold War. The government needed massive spending for military and industrial strength. In that environment, it became politically difficult for the Federal Reserve to maintain tight monetary policy indefinitely. Today, there are echoes of that same dynamic. Strategic competition between the United States and China is becoming the defining theme of the era. Political pressure surrounding interest rates, fiscal spending, and Federal Reserve leadership is intensifying. Napier's argument is that history suggests central bank independence often weakens during periods of national geopolitical competition, and the next decade may not be an exception. Second counter-argument. What if AI triggers a productivity boom large enough to solve the debt problem through growth? In theory, this is absolutely possible. The 1990s provide a historical example. The internet revolution drove major productivity gains and rapid economic growth. By the end of the Clinton administration, the U.S. even achieved budget surpluses. Technological revolutions can indeed reduce debt burdens through growth, but the key issue is timing. Historically, productivity revolutions often take years before their effects fully appear at the macroeconomic level. The internet became commercialized in the early 1990s. Yet productivity data only clearly reflected its impact in the late 1990s and early 2000s. AI may follow a similar path. The technology already exists, but fully integrating it across industries, changing workflows, and boosting aggregate productivity may still take years. The problem is that debt will not wait. In the United States alone, federal debt recently increased by more than $7 billion per day. If debt grows faster than AI-driven productivity improvements materialize, financial repression may arrive before AI fully transforms the economy. Of course, the ideal scenario is that AI produces a productivity boom comparable to the 1990s. If that happens, debt burdens could naturally decline without financial repression. Everyone hopes for that outcome, but investors should not rely exclusively on one optimistic scenario. Third counterargument: can capital controls really work in a globalized world? From 1945 to 1980, international capital movement was already more restricted under the Bretton Woods system. Today, capital can move globally with a few taps on a smartphone. Financial borders are far more porous. Comprehensive capital controls are therefore much harder to imagine, and Wall Street possesses enormous economic and political power. Strict capital controls would directly threaten its interests and would almost certainly face fierce resistance. Still, signs of increasing friction are already appearing. Tariffs are not capital controls, but they increase cross-border costs and send a signal that policy environments can shift abruptly. Some countries are also increasingly guiding pension funds, insurance companies, and banks toward preferred investment directions through regulation. So perhaps the future is not one of total capital control. Instead, it may be a world where capital flows face more friction, more restrictions, and more government influence. The era of perfectly free global capital movement may no longer feel inevitable. And in this new system, Wall Street may not necessarily lose. Again, Larry Fink and BlackRock illustrate the point. If governments want private savings redirected into infrastructure investment, Wall Street can position itself as the intermediary and collect fees along the way. Financial institutions will adapt to the new rules. Fourth counterargument, one Napier himself openly acknowledges: government-directed capital allocation often creates massive capital misallocation. Markets allocate capital based on efficiency. Politics allocates capital based on votes, power, and national security priorities. Politicians may pour money into projects that maximize political support rather than economic productivity. Napier points to Britain from the 1950s through the 1970s as an example. Huge amounts of capital were directed into coal mining, British Leyland, and the Concorde supersonic aircraft project. Most of these investments ultimately failed commercially. Coal mining declined. British Leyland struggled badly. Concorde never achieved the commercial success originally envisioned. Classic examples of capital misallocation. But Napier's key point is different. Even when government investment eventually proves inefficient, it often takes many years before those failures fully emerge. In other words, during the first 10 to 15 years of heavy government investment, investors may still profit by following where policy and capital are flowing. As long as geopolitical competition and national security narratives remain powerful, governments are likely to continue investing heavily. And today's environment, US-China rivalry, supply chain restructuring, defense spending may sustain those narratives for quite some time. Investors, therefore, do not necessarily need to determine whether government policies are ultimately correct. A more practical question is, where is policy directing capital right now? Which industries are receiving orders? Which narratives is the market believing first? History suggests these questions often matter more than abstract debates about efficiency. So after understanding the framework and the counter-arguments, how should one invest? Napier offers very clear views on different asset classes. First, the asset class he dislikes most: bonds, especially long-duration nominal bonds. The essence of financial repression is the slow destruction of bondholders' purchasing power through inflation. You receive fixed interest payments. But if inflation runs at 5% while your bond yields only 2%, you are suffering a persistent real loss. Napier has stated very directly in recent interviews and speeches that from 1966 to 1982, the historical period he believes most resembles today, holders of long-term bonds suffered severe real losses. During that era, bonds were not safe assets. They were assets slowly carved apart by inflation. He is also cautious on large U.S. growth stocks. Why? Because the extraordinary performance of American growth equities over the last 40 years was driven in part by one major structural force: continuous global capital inflows into the United States. Those inflows help suppress interest rates while simultaneously inflating asset valuations. And interest rates matter enormously for growth stock valuations. The value of a stock equals the present value of all future cash flows, discounted back to today. Interest rates determine the discount rate. When interest rates are low, future profits become far more valuable in present terms. A company expected to earn massive profits 10 years from now looks extremely valuable when discounted at 3%, far less valuable when discounted at 8%. That is why growth stocks exploded higher during the zero interest rate era of 2021. But now many of the structural conditions supporting ultra-low rates are weakening. Foreign capital may partially return home. Capital nationalism may rise. Deglobalization could increase inflationary pressures. If discount rates rise, richly valued growth stocks face major pressure. So what does Napier prefer? Value stocks. Very clearly. During the 1966-1982 period, the assets that held up relatively better in real terms were companies with strong current cash flows and reasonable valuations. These firms did not depend on optimistic stories about profits 10 years in the future. And in an era of industrial policy and infrastructure spending, many government contracts naturally flowed towards sectors like infrastructure, manufacturing, energy, and defense. Previously overlooked value companies may suddenly regain growth characteristics because policy support drives new demand. Regionally, Napier favors three broad areas. First, the United Kingdom. Over the past 15 years, Britain's private sector has undergone an extended deleveraging process. Households and companies became cautious and focused heavily on repairing balance sheets. That process suppressed economic growth. But if deleveraging is nearing completion, previously restrained growth momentum could begin re-emerging. Second, Japan. Napier's view on Japan is more nuanced. Japan still carries one of the highest debt burdens among developed nations. Government debt exceeds 200% of GDP. Japan may therefore become one of the strongest examples of financial repression in practice. Japanese authorities could increasingly encourage domestic institutions to hold Japanese government bonds, causing life insurers and pension funds to reduce overseas allocations, especially U.S. assets. This could support the Japanese yen over the long run. At the same time, Japan is also pushing corporate governance reforms designed to improve shareholder returns, which benefits Japanese value stocks. Third, selected emerging markets. Their advantage lies in lower debt levels and relatively healthier fiscal conditions. But Napier adds an important caveat. Not all emerging markets qualify. Countries with weak property rights should be avoided. Countries with fragile legal systems should be avoided. Countries with overvalued currencies should also be avoided. He explicitly states that he does not invest in China because the risk of trapped capital is too high. He even says something memorable. If it's not a country you would retire in, don't easily place your capital there, because once serious problems emerge, your money may become extremely difficult to retrieve. Russia serves as a painful historical example. Finally, gold. Napier remains structurally bullish on gold. Not merely as an inflation hedge, he argues that in a world of financial repression and increasing friction in capital flows, gold becomes attractive because it does not depend on the creditworthiness of any government. Stocks and bonds both exist within financial systems shaped by governments. Gold does not represent anyone else's liability, and historically, gold prices often move inversely to real interest rates. Financial repression aims to push real rates negative. When real rates are negative, holding a non-yielding asset like gold suddenly becomes rational because even cash is losing purchasing power. The deeper financial repression becomes, the stronger gold's logic grows. Not because gold produces cash flow, but because it does not require someone else's debt in order to maintain value. So let's summarize Napier's broader message. For the past 40 years, we lived in an unusual era. An era defined by efficiency, market freedom, free capital flows, central bank independence, and interest rates largely determined by markets. An era where your money was yours to place wherever you wanted. An era where governments generally stayed away from private savings. But if you zoom out across 100 or 200 years of history, that 40-year period may actually be the exception. Over much longer stretches of history, governments suppressing interest rates, guiding capital flows, and quietly transferring purchasing power from savers to borrowers has been far more common, and that historical pattern may now be returning. Debt burdens have become too large. Conventional solutions are politically difficult, so governments may increasingly rely on financial repression, keeping interest rates below inflation and gradually inflating debt away. This process could last more than a decade. During that period, long-duration nominal bonds may suffer. Large U.S. growth stocks may lose some of their former dominance. Value stocks and real economy industries may regain importance. Gold's structural logic may strengthen. And global capital may no longer flow automatically into the United States, instead redistributing toward countries like Britain, Japan, selected emerging markets, and domestic strategic industries. Taiwan, interestingly, may occupy a relatively favorable position within this trend. Semiconductors, defense, shipbuilding, manufacturing. These are exactly the types of sectors governments may prioritize in an era of state-guided capitalism. And Taiwanese investors are already accustomed to interpreting government policy as part of investment analysis. Of course, this framework is not guaranteed to unfold exactly as Napier predicts. AI could trigger a productivity boom that alleviates debt burdens naturally. Central banks may genuinely preserve long-term independence. Capital guidance and financial repression may encounter major resistance in a globalized financial world. But the important point is not whether Napier is perfectly correct. The important point is that he is asking questions worth thinking seriously about. Will interest rates always remain purely market-driven? Will your money always flow wherever you want without friction? Will governments always stay away from private savings? Every investment decision you make today, what you buy, where you hold it, how long you own it, may be shaped by these larger forces. And simply incorporating this possibility into your thinking may already make your investment decisions more thoughtful than most people's.